Good morning. I think we're ready to start. I think everyone's sat down. Thank you very much for joining us this morning. Everyone's looking very wide-eyed and bushy-tailed, considering the football was on last night. Thank you for making the effort to join us this morning. Today, this is our third Succession event. And if you were here last time, we were talking about planning, gifting, trusts, family investment companies. Today is pre-exit planning for business owners. We're doing a panel format today, and we'll welcome questions throughout. So if you've got questions when our panel is speaking, please just raise your hand and someone will come round with a microphone so that it can be picked up on the recording. We can hear you. So today on our panel, we're very pleased to have first of all, introduce myself. For those that don't know me, I'm Clara Staunton. I'm a partner in the private client team, so Wills, Trust and Probate. So we're not focusing on my area today, but if you do have any queries at the end, me and my team will be happy to answer anything. We've also got Scott Sands from our corporate team, and he will do a little intro on himself in a moment. And we're very pleased to have some special guests with us today. We've got Nick Wyatt from RSM and Colin Lawson from Equilibrium. So I'll just hand over for them to do a brief intro before we get started onto the subject matter.
Good morning all, Colin Lawson. I'm the founder and managing partner at Equilibrium Financial Planning and Equilibrium Investment Management. We look after about 1.2 billion on behalf of 1,000 families, and so today I can speak of my experience of a business owner over the last 30 years. But also with working with hundreds of business owners over the last 3 decades or so.
Morning everyone, my name is Nick Wyatt. I'm a mergers and acquisitions partner at RSM. We are a global business at RSM. My day job is to advise shareholders, management teams, businesses on transactions, and we'll come on to talk around the different types of transactions that we get involved in and that we advise on. But fundamentally, we are advising owner-managed entrepreneurial businesses, predominantly looking at succession planning and retirement sales and transactions. So looking forward to talking more about that today.
Thanks, Nick. I'm Scott. So I'm a partner at Myerson Solicitors. I'm specialised in corporate law, so M&A transactions. I've been doing it for 20 years, believe it or not. I know I don't look that old, but 20 years now. And yeah, we're going to talk about basically what you need to be thinking about as part of the run-up to the transaction itself, and then just really a bit of planning and prep.
Lovely, thank you very much. So I think we'll dive straight in, and I think we'll start with Colin. What is the first thing that people need to consider when they're looking to exit their business?
Well, first of all, I also don't look old enough to have been doing this for 30 years either. But anyway, let's move on. The first thing always is know thy numbers. What is the exact amount of capital that you need to make sure that you can live the life that you want to live, look after those that you love, and leave a powerful legacy? And in 30 years of doing this, I've never met a business owner, either prior to sale or after the point of sale, that's got a really good grasp of that number. That's a bit of an exaggeration, because often people will have a DIY spreadsheet and they'll come in and they've done their own calculations, but invariably those are wrong. And they're not just wrong, normally they are wildly inaccurate. And it'll be for 2 reasons mainly. One, they will underestimate the returns that they can achieve on that capital going forwards. And secondly, they will overestimate the amount of tax that they're going to pay on that capital and the income from it. When I say overestimate the tax, I'll just give you an example. If we structure things right, if you give us the opportunity of pre-planning, I think we're all going to talk about pre-planning this morning, then we should be able to get to a position as an extreme where you can have £1 million income as a couple and pay an effective rate of tax at around 15%. Now, I've actually had accountants write to me and say, how is it that our clients have got so much capital and that much income and are paying such little tax? And it's all about the pre-planning. Now, if you've got a DIY spreadsheet and you're assuming a 45% rate of tax and you compound that over the years and we can reduce that by 2/3, that's going to have a massive impact on those numbers. So then coming on to returns, and it's the most important one to have a good grasp of, and we all ask the wrong questions. Asking about the past returns over the last 5 years or last 10 years is irrelevant to a planning lifetime cash flow forecast. A better question might be, what are the target returns from that portfolio? But that's also the wrong question as well, because a target is just that. If I'm going to be presenting you with a lifetime cash flow, and I'm saying this is what you're going to base your life decisions on, this is what you can afford to do, you've got to have a really good degree of certainty that that's going to happen. So a better question is, what are the packing parachute returns? What are the returns that you can be certain of? And so we talk about rolling 5-year periods and probability of returns. Has that strategy been stress tested where over, let's say, if I was looking at a 5-year period, I'd want it to achieve the returns on that strategy at least 75% of the time. So if you're aiming for, say, 3% above inflation as a planning assumption, I want to know that 75% of the time you're going to hit that. Over 10 years, I'm looking for close to 100% of the time. Now, the next question is, great, you talked about packing parachutes. Well, if I only survive 75% of the jumps, I'm not going to last very long. So I now need to look at marginal slippage. What happens on the other 25%? Is it that I miss it, but it's now 2.5% above inflation? That's okay, I can catch up in the next 5 years. If it actually ends up being 5% below inflation, that could be disastrous. So it's how good's the parachute, or how good is the backup parachute? If you can get a really good idea of those numbers, then it allows you to make sure that you can sell the business at the right time for the right amount of money. Because what I often hear back from business owners is, oh, I could have accepted that deal, I didn't realise. So they walk away from a deal that they could have taken that still would have given them more money than they'll spend during the rest of their lifetime. The other one is that people then delay a deal, might put it back another 5 years. That could have health consequences, they can miss out on 5 years of fun and life, and I'll touch on the emotional aspects of selling later on, because it's not all about the money at all. But that's my first one, is get a really good grasp on those numbers so that you know what you're walking into.
Thank you. Yeah, valuable advice there. So once you do have a good idea of the numbers, perhaps Nick, you could talk us through, planning in terms of what the options are for business owners.
Yeah, sure. I think that comment that was made there by Colin, know your numbers, I think that is really, really important, really, really powerful. Every transaction we advise on, the first thing we will do is work with the shareholders to understand the business, really look at the business model, look at the customer base, look at customer concentration, all these different things that can impact value. We will spend time with the business and the shareholders looking at that, and then we can give a really, really strong appraisal of what we think the business is worth. Once you know those numbers, you can then factor that into your longer term planning. Does that achieve my objective? Does that get me to where I want to? So that's the first thing we'll always do, is look at a business and say, okay, 100% of the business, what is that worth today? Once we've done that, and just to caveat that, it'll always be a range. We'll never commit to an exact number, but we'll give you a range of where we think the market's at, and that's by knowing what sector you operate in, what sort of multiples, what pricing is being paid. Buyers will often pay a multiple of profits. In the software sector, a multiple of revenue, but that's how business valuations are formulated. And then, of course, there's adjustments to that price as well. But we can bring all that together. We work with our clients to look at that early on in the process to make sure we're all aligned and it then achieves the ultimate goal. The different types of transactions that you can look at will then influence what level of cash you'll get and when. So just because a business might be worth £10 million doesn't mean that you will get £10 million on day one. There'll be different transaction types, different types of buyer, and that will dictate the different types of structures in a transaction that you're likely to receive. So a trade sale, for example, a sale of a business to another corporate business, often operating in the same sector or a complementary sector, is often seen as the simplest option, often the one that shareholders will talk to us first when we first start talking. That is a transaction that typically enables the highest cash out on day one in terms of structure, but not always. And it can also mean that there's synergies that a buyer will obtain, and therefore they can look to value the business more attractively, potentially. But there is a huge alternative, which is a private equity type transaction. Now, what this will mean is this could be a management buyout of the business that is backed and funded by private equity, or it could be a partial de-risk and cash out, again, that is funded by private equity. Now, over the last few years, we've seen an increase in the volume of private equity transactions proportionate to corporate transactions. So that's increased by 13% over the last 5 years, and that's now at 42% of all transactions are funded by private equity. I was surprised when I saw that stat actually myself, but that is where we are today, and that is because they have so much money that is sat there that they've raised from their institutional investors. They've got that money sat there, and they need to spend it, they need to deploy it, they need to get their return. What a private equity transaction will often mean is that you will not get 100% of transaction value on day one. So back to Colin's point, if you are thinking about the long-term plan and are you going to achieve your goals, if you're looking at a private equity transaction, then there needs to be a sense check of, okay, I'm not going to get that whole value at that point in time, and typically it will be a 5-year window that you'd work with the investor to ultimately then exit the business. So that needs to be factored into your planning. Obviously, if things go well, it can mean that you get a very good result at the end of it, but that all needs to be factored in terms of timing and what those different transactions can mean in terms of structure of what you get out and when you get that money out.
Thank you. Yeah, so it's really important to understand the pros and cons of each option, really, isn't it? So, Scott, what do people need to think about then about structuring their exit?
So, we talked about the price, what the price you need to achieve, how are you going to achieve it, multiples and based on valuations of profit and also by turnover. But is your company, your business ready for that transaction? You know, I spend my day talking about risk to clients, selling, buying, trying to find that right balance. But if you don't do the preparation before the transaction's ready to go, and it depends on what we said before, as Nick says, you know, who's buying, you know, have you done your homework? Because the whole share deal is about price adjustment. You start off with a figure, you do the deal, you do due diligence, you get your information, you find out where the holes are, and then the price could come down. Or, worst case, you find out afterwards that there's a hole in the accounts, there's R&D that's been claimed that never should have been claimed, and then you've got to pay that money back. So the whole idea is, are you ready to go? How do you get that number that is in your head, because for your exit, for your retirement, in order, and then do it. So it's all about thinking way beforehand. And as Nick says, there's different types of deals. You'll have the trade buyer. Trade buyer is great. But that trade buyer could call you up tomorrow and say, right, I'm ready to do the deal. This is the number. It's a number you can't refuse. The timing's right. You're ready to go. You might have weeks or months then to get the deal done from that stage. Alternatively, may not be a trade buyer. It might be something that is led by the vendor. If it's vendor-led, the seller is taking lead here. He's basically gone, right, I know the numbers right now. I'm ready to go. Is the business ready to take over? And this could be various structures. It could be a PE-backed management buyout. So the vendor goes to PE, says you're interested in the business, I've got a management team, let's go. And that could be a year, 2 years practice. What about other structures? What about just a vendor-led MBO? What about the vendor says to the management team, right, let's go. I'm going to give you 5 years and we're going to set things up and get the ball rolling, and in 5 years you're in charge. What needs to be done then? Well, it really depends on who the management team is. Do you have a management team? Are you doing everything yourself, or do you have that CEO, COO? Do you have a CFO? You got financial arm in there? Who's in charge of sales? If you step out of that business tomorrow, can that business survive without you? If not, PE aren't interested. You haven't got a management team to run it. Where are you going? Now, there's deals where you get earn-outs, fine, you get some time afterwards to maybe build that management team up, but you really got to start thinking beforehand, have you got the right people? Can you step out of the business tomorrow and let the business carry on without you? And often, the answer is probably no. So when do you need to start thinking about that? Now. Really need to think about who's in your management team now ready to do this. And who's to say the first people you recruit to do that job are the right people? What if the culture doesn't fit? What if they're rubbish? We're talking 2, 3, 4, 5 years of planning here to get the right people in, and then you've got to keep them. So how are you going to keep them? You've got to retain them. How are you going to motivate them to be retained for this? And then you're looking at options like share options. What is in their contracts of employment? Are you giving them the package they've got? These were expensive things. So you need to start thinking way ahead of the deal and try to just make sure that you're ticking all these points and talking to us, basically.
Yeah. At this point, do we have any questions from the audience at all? Yes. Just get a mic to you so everyone can hear you.
Morning. We've spoken to a few people about selling over the last year or so, and the estate multiples now, we're seeing EBITDA, turnover, profit. What is the standard? Because also the variables are massive, from 3.5 to 11. So who's right and who's wrong, and what is the norm?
Should I take that one? I mean, in your case, the 11's obviously the right number.
Yeah,
definitely. It's the reason I caveated what I said before around valuation is entirely for that reason. It sounds, it's a cliche, but beauty is in the eye of the beholder. So we've worked with businesses, for example, where it's a software business. They've got a product that a buyer knows they could take that product and they could cross-sell it into their existing client base. And there's no surprise that those with the bigger client base can then pay more for the business because they've just got more in it for them in the longer term. There is generally, we generally know in different sectors, different types of deals, different transaction types, different business compositions, we generally can give a good steer on what that would be. I'm not surprised to hear you say somewhere between 3.5 and 11. It can get that wide in terms of the range that different buyers will value the business at. The important thing that you mentioned as well, I think, is that the multiple is only one part of the equation.
Yeah.
You've then got the profit itself. Well, what is it? Is it profit? Is it EBITDA? Is it cash EBITDA? There's lots of things to think about there. And are you presenting the right EBITDA number? So if you have a set of management accounts every month and you say, well, I think the multiple is 10, and my management accounts show me that my profit is £1 million, so I think I'm worth £10 million, then we may look at it and say, well, actually, we think that your profit is £1.2 million because actually you've got those costs in there that are not going to carry on post-transaction. So now you're looking at a different equation there. So actually, I don't need to get to that 10 times multiple to achieve my 10 million valuation.
Yeah.
So knowing the number is really important of where you want to get to, but how you get there will really take some scrutiny of the numbers, understanding of the business. If there's things in there like customer concentration, that'll suppress the multiple from, say, a 10 to a 6, depending on the level of concentration. But there's all these different nuances in each business that will mean on the scale of an EBITDA multiple will dictate where you come on that scale. But again, it is down to the buyer and what they can do with the business going forward and what value they perceive in it as well. That's why you get that variation in multiple.
And I'm assuming you look at a company and how it's structured and what sector it's in, and that's pretty much, you can give a figure to what that EBITDA or multiple should be.
Absolutely, yeah. We as a firm, we are the third most active advisor in the UK. So we deal with a lot of transactions year on year, and we have a lot of data and a lot of statistics. So if we say, well, it's a certain sector, we're sector agnostic. If we know that it's a certain sector, we can drill into that pretty quickly with our own hands-on experience of knowing exactly what multiples different buyers were offering on that transaction, and that's how we come up with our view on what the range will be. Of course, there's then publicly disclosed information, which is not every transaction, because people like to keep that to themselves if they can, but there is publicly disclosed information which will again give you a guide on the multiple.
Yeah, thank you.
If I can come in there as well, I think there's a lovely phrase called fish and chips. I don't know if you've heard of that one, but it's where they fish you in, reel you in on one number, and then chip you down all those things that you've already mentioned that aren't quite right. So sometimes somebody might reel you in on an 11 times multiple and then chip you all the way down to 7. So it's about being realistic about what you think you can expect. But also looking at what are the drivers that they're looking for. What is it they value the most? And what levers can you pull before sale to increase those? So if it's recurring revenue, for example, are there ways that you can, even if it's decreasing overall revenue, if recurring is valued more, can you increase recurring revenue to increase the value? So everything isn't always equal. It's looking at your sector and the buyers in that market. What do they really want?
And just one final point there, a lot of the deals we're seeing at the moment are PE-backed trade deals, so they're coming across, very keen to do it. Multiples are 6, 7, something like that. So the seller expectations not great. May not be the 11 times you're talking about, but the structure is very interesting at the moment. So a lot of the deals are you're going to get this on completion. You're then going to get an earn-out over the next 2-3 years. So if you hit this EBITDA going forwards, you can pay yourself out of that profit a little bit more. And the cherry on the cake is, here's some shares in the buyer too, so that when they exit the PE deal that they're in at the moment, either sell, list, or sell to another PE back thing, you get another tickle. So the kind of multiples are starting point, but the buyers are being very attractive at the moment and offering deals that are not just about the multiple. So they, as long as you're in it to win it towards the end, and put the effort in on the earn-out, which is not easy, and I think you'll pick up on that, Colin, if we get a chance. There's good opportunities out there for a seller.
Okay, thanks.
Yes, no question?
Colin, you mentioned a number. How do you get that number? To me, if you're walking away with 5 million or 10 million, is it going to make any difference to your life for the next 20 years or whatever?
But isn't that the exact question? So how do you get that number? It's about sitting down with you and trying to find out what is the life that you want to live. Most of us have a standard of expenditure that if we have to go below it, we feel uncomfortable. If we have to go above it, we feel uncomfortable. Most of us in the room will have a standard that we'll spend on a night in a hotel, on a bottle of wine. So finding out each individual number should be relatively easy. It's just saying, what do you want? And I said, and that's just you. Who is it that then you want to look after? The kids that you want to buy houses for? How do you want to support people? Factor all of that in. Factor in some of those, what are the returns, what are the tax we're going to pay, what's the inflation, what are the uncertainties, run it through various different models and stress test it, and then come back to a number. But that's absolutely right. If you know whether it's 5 million, 10 million, 7 million, that's kind of important. And as business owners, most of us are really good at having a business plan. Especially as we're coming closer to the point of sale, that business plan should become better and better and better. And then somehow we stop the plan there. And you're like, guys, is your life stopping when you sell the business? Where's the plan for after the business? And that's where it's really important. Does that make sense?
Any other questions at this point? No? Okay. So I think we were going to also touch on other advice for clients, because it's obviously not just about the tax and the figures involved. If someone's been involved in a business all their lives, they've built it up, there's an emotional side of it as well, and there's a lot of other things to think about. So I don't know if, Colin, you wanted to start on that point.
Sure. I think the emotional side of a sale should never be underestimated. So I said, I set my business up 29 years ago from scratch. So it was a child. I gave birth to it. I got it through its toddler stage. It was horrible. It was having tantrums. We've been through puberty together. It's grown up. It's now an adult. And as we said, if you're going to sell your business, it should be able to stand on its own 2 feet without you. And that's a big change. And I look at a business sale done wrong like a bereavement. You give up what you love in exchange for that big check, whatever that number might happen to be. And then we're just supposed to swan off into the sunset and enjoy ourselves. But then we lose all the things that running a business gave us. And Anthony Robbins, the American guru, love him or loathe him, it doesn't really matter, as a simple concept that we have 6 human needs. So you have certainty. Well, I have certainty that I know how to do my job. I've been doing it for 28 years, it's there. But then we need uncertainty. We love the change. Every day is different. You've got contribution. You contribute to your clients, you contribute to your team, you contribute to the economy, you're giving something back. You're getting growth because you're learning every day. If you're not growing, your business is going to be dying. What else do you get? Significant. You're a business owner. That has a label with it. What's the first question people ask us when we first meet? What do you do, Scott? And then you have to say, I used to. Then you become a has-been overnight. That's not very nice, is it? You then get connection and love. All of those needs you get through running a business. So why am I still doing it 28 years later? The check's big enough now, I can sell it. But every day I get all of those boxes ticked. So how am I going to tick those boxes post-sale? There's a reason why a lot of business owners, once they sell, get into property development. And it has nothing to do with that being a good strategy around making money or tax. It's about significance. It's giving them something to meet those needs. So actually addressing in advance how you're going to meet those needs once you've sold is critically important. believe it or not, the rates of depression and the rates of divorce skyrocket after business sale. And that's bizarre, isn't it? You've built your business, you've got all your money, and now you're miserable as sin and you get divorced. Hooray! Now you haven't got as much money, and you're definitely not very happy. So, all the bits we talked about are really important, but actually we're doing this because we want a life. And you can't underestimate that. So I think really giving that some thought in advance. And coming back to knowing the number, quite often I'll talk to people and say, oh, well, I haven't got enough money at the moment. I've got enough liquidity at the moment. No need to talk to you. Everything's in the business. I'm saying that's got nothing to do with planning. We've got two businesses for a reason. One does investment, one does planning. So the earlier you start the planning, it's a message coming across, the more likely you are to be successful.
Thank
Sorry,
you.
long answer.
I think just to add to that, and I'd echo everything we said there, it's an emotive process, and I think shareholders will often underestimate. If I said to you, someone's going to come in and do due diligence on your business, you might think, well, it's fine, I'll spend an evening pulling some information together, that'll give them everything they need, and we'll get this due diligence done in no time. Just that process itself is so involved, it is so intense. Preparing before you get to that stage is really important, because once you get to that stage where you've got someone with a deal on the table that works for you, it's all about closing that deal out as quickly as possible because of the emotive pressures that it brings, because of the risks around something happening in the market, tax rate changes, anything else that could happen that then creates risk around that. You want to get that done as quickly as possible. Due diligence is a drawn out process, and therefore we need to be prepared to get that done as quickly as possible. But there are other pitfalls in a transaction that can lead to that added stress, that added pressure. And again, we'll come back to it. We've said the word so many times, but preparation. That is the really important thing. One of the biggest things that we have in transactions is where shareholders think we'll sell the business and then we'll be free to do what we want to do and we'll get all our money on day one. And coming back to the structure point that we mentioned earlier, that is often the biggest shock when we say, well, hang on, you do the sales, you've got all the customer relationships, how are you going to just sell the business and walk away? How is a buyer going to get comfortable to pay you all that value on day one? Because what then locks you in? What incentivises you to stay with the business and do what you need to do? So it's about that preparation. It's about thinking, how do I remove myself from the business to mean I've got a management team running it for me? And that just gives you more options on completion of a transaction.
Yeah, that's really hard to do because, as Colin says, it's all about you, isn't it? You're selling your business. And separating yourself from the business and being not important anymore, just that first kind of step is there. But just 2 points to pick up on there. The emotional point is, I mentioned before about earnouts, tying you in for 2-3 years, you hit this number. You run a business, set up a business 30 years ago, you brought it here, you've been in charge of it 30 years, you probably set your own business up in the first place because you weren't employable at the time, you had ideas that you weren't ready to work for someone else. Why do you think after 30 years running your business, you're going to be able to work for someone else all of a sudden? So one of the things that we are very conscious of when we're advising clients is really kind of go, look, when you structure your deal, you're going to get this on day one, you're probably going to get a bit of an earn out and a tickle there, but you're going to have to toe the line for 2-3 years and have some spotty kid telling you what to do. Are you ready for that? Is that something you're prepared to do? So you really need to kind of get that figure higher up on completion to say, well, if I only do 12 months and I walk away, is that enough for me now? So again, it's all about what is the number that you can settle for, what's the number you walk away with, and build that into the structure of the transaction. The second point is due diligence. We've got a deal at the moment, relatively small business, 10 staff. He's gone on holiday. We're in the middle of a due diligence process. It's messy. He's not taken legal advice previously. We're trying to sort things out. It's taken up all his time. And it's just nothing else is happening with the business. Now, you're trying to do a number, a valuation based on your EBITDA and your profitability at the data completion. If you're distracted from the business in the last 6 weeks doing this due diligence process, how are you going to maximise that profit? You can be distracted, it's not going to work. So again, starting early is really important. One of the things that, as part of the process, you're going to start probably 3-6 months beforehand on the transaction is the DD process, due diligence. And it's going to be legal, it's going to be tax, it's going to be financial, it's going to be commercial. There's a lot of people involved in that process. A lot of time is taken up in doing it. But there's nothing to stop you if once you've decided to go to market and actually sell, doing that process yourself. Yes, it's kind of an additional cost, vendor DDs seem to be expensive, but then you take all that pressure and weight off you in that really busy period running up to completion. So you can go to a lawyer and say, right, let's do a vendor DD. Let's go to the accountant and start pulling numbers together. Let's look at what everything looks like. Let's find the holes. We see the same issues day in, day out on every single deal. Who's got the register of members of the company? Who's got statutory books? The accountant's got them. Speak to the accountant. Have you got them? No. Speak to the previous accountant. You got them? No. They've disappeared. Right? Without this piece of paper, you can't sell the company. It's impossible. So we start with that one. Richard's in the audience here. IP. Who owns the IP? You've got a software business. You are looking to sell software business. Who owns the intellectual property to all of that? Who's got the database? Where's the copyright? Where's everything else? Do you own it? Is it in the name of your employees? Still okay. But you've got consultants. In the early days, you probably had a load of people just writing stuff for you because you couldn't pay them anything. There's no paperwork. Again, have you done your IP audit? Are you ready to go? And just look for other holes. Commercial contracts. I've got a deal on at the moment, and they're saying you've got no limitation of liabilities on any of your contracts. They're a small business, and they're dealing with big businesses. So they want any claim under that, any of those contracts to be covered by him pound for pound. So spend time. Let's look at your contracts. Where are the risks? Have you got a long enough notice periods on them? Have you got limitation of liability? Have you got a cap on how much they can claim under that contract? Let's tidy things up. Package everything up with a nice bow, put it all in a data room and say to the buyer, here you go, tell us what else you need to see.
Thank you. Any other questions at this point? Yeah, at the front.
Hi, so it's complicated. So I'm a first-time founder. I left the military, worked in software, built a software company, started going monumentally massive, and obviously for me, it's been like a learning curve like this. Now, fast forward 7 years, and we've got 600 shareholders, and our board has people like the former head of Oracle, American Express, people like that, right? So I have people who are much, much more clever than me, which is great. Now, next week, I'm in a meeting about a potential merger / acquisition, and I'm so far out of my wheelhouse, I don't know what's going on. Now, I do trust my board members, but they have their own agenda. But for me, as a very poor founder who's just trying to get to that next level, from the face of it, the merger, and I know the other co-founder, we have mutual investors, funny old thing, makes complete sense to us at the coalface level. It will probably triple our valuation. But I go into that meeting next Thursday with some of these really big people, quite nervous about how I protect myself in that situation. So the emotional thing is great, but for me, when you've got the former head of a FTSE 100 company, he can afford to go and get legal representation. When you're a poor founder, paid as little as they can possibly get away with, it's really hard for me to go and get myself a lawyer and a team to represent me in the best interest. So have you seen this before, and how do I deal with this? I'm a client, by the way, so you're doing my contracts.
Oh, okay, that's fine, that's right. You're not the first person. You know, God, we as lawyers, we get into the deal very late. I'd like to be into deals a lot earlier and go through that hand-holding stage and do the prep and everything else like that. We rarely do. So, you know, if we look at a standard timetable, if we say we start prepping 2 years for a sale, my bit's like the last 3 to 6 months, tops. I'm not involved. I might get the signed heads of terms from Nick saying, look, it's got deals on the table. This is what we've agreed, because I don't do the numbers. I don't do the valuation. I don't negotiate the price or the structure. I just do the legal bit. So a lot of the stuff happens beforehand. I would say it's very much like Dragon's Den. You go into Dragon's Den on Thursday, right? You can do your pitch, you're going to do it, and you listen. Because 90% of the deals that shake hands on the Dragon's Den never happen, right? If you look at 12 months on, all these great pitches and everything like that, as soon as the due diligence process starts, as soon as they start looking at who's got this and who's got that, the dragons pull out. So nothing really happens. So really, at this stage, there's a lot of listening. A lot of listening, a lot of pitch, a lot of shaking hands and everything like that, doing the right thing. But you're not committing to anything, right? You got to come to the figure, you got to come to head to terms. Head to terms could take 6 weeks to negotiate and get that to that point. And then that's all still subject to contract. So once you've got the legal team in place, which really, as I say, at heads of terms, preferably beforehand, happy to come to a meeting with you, there's not much you're going to have to commit yourself to. Nick, you probably spend more time in those meetings than I do.
Yeah, and I think it's a really interesting point, because we've talked here around a simplistic world of one single shareholder on 100% of the business. On one hand, you and all the other shareholders are very much aligned. You want a transaction that maximises value, because if the overall value is higher, then you all win. But then you've all got your own little nuances of what works for you, what doesn't work for you. You've all got your different roles in the business. So some of you will work in the business, some will be hands-off, passive investors in the business as well. What we will often advise the whole company, the whole group of shareholders, but we'll also often need to advise one portion or one individual shareholder in that group. We see that quite a lot when it's a private equity transaction, for example, because you've got a private equity house coming in who wants to pay obviously as little as possible to maximise their returns on the ultimate exit. You might have a management team who are going to receive some shares as part of that transaction, and therefore technically they're a buyer. And then you've got the exiting shareholder who's cashing out, who technically is then a seller. And that management team works for or with that shareholder who's the majority shareholder. And you just see these conflicts of, we want to try and keep the value as low as possible, because we're going to get a share in the group going forward. The higher the returns, the higher we get out in terms of our share. So there is always naturally going to be conflicts in the group. Clearly, you want to keep it as amiable as possible. You want to be a friendly deal. You want everyone to walk away happy. But I think 600 shareholders is quite an extreme number. But it is important that you each get your own advice to look at what does this mean for me as a deal. So there's so much that can be done by one lead advisor who'll transact overall. But then each individual just needs to think about their own position. I'd echo that point. You go and listen, you absorb, you see what's to be said. Don't commit to anything, and then you can take that away. You can think about it, and then you can come back to the table. And if it's a position where everyone else around the table is quite experienced in terms of doing deals, we work with people who are going for the deal for the first time, typically. So we will handhold through that process. But it is important that you sort of take your own advice.
It's really interesting because we want to acquire them. I don't have £3 million sitting around to acquire them. They bring us a market of about 1 million people. I wish we could. We could go and get investment to raise the money to then go and buy them. But the mutual investors are thinking, well, actually, together you're a bit of a powerhouse, so how do we merge? So he's only got a couple of shareholders, one of them is ours. So bringing them into the fold and perhaps buying a 25% stake to lower that. But it makes me very uncomfortable because we was approached by a PE company who offered us 50 million. With an immediate 5 million to put into the company, not off that 50 million, with targets to hit, and then that triggers the buyout. But then when I sat down and worked it out that if we hit their targets, we'd be worth 100 million. So they're trying to get us to commit early to then drive the business. So, for me as a silly veteran who's just sort of learning and playing a game, it's quite a scary thing. So
I think excuse me. I think it is complex. It's probably one we can catch up on after. But I also approach it with some common sense questions. You can see what you're gaining from it, but what are you losing from it? Are you losing any control? Is it a different class of shares? If you are, how can you protect that? So just really thinking about the questions that are bothering you and asking those directly and seeing how you can protect your interests it's a good starting point, if nothing else.
Just one point on the 600 shareholders. I'm guessing they're early stage investors that helped you at the beginning to put some cash in?
Yeah, so there was a friends and family round for 20 people, 20 grand, and then 4 crowdfunding rounds.
Yep.
So the seeders and crowd are the main.
Yep.
If I want to make a decision, I have to run through.
Yeah, I've got seeders on one of my clients as well. They're great fun. And the secondary market is very useful, but it does start diluting your position. One of the things we need to talk about is then your constitution, how we're going to present 100%, when we merge, how do we get rid of these 600? They're going to want to get out, but we need to make sure we can get their shares, because if Cedars turn around and go, actually, this isn't the best figure for return for us, we're not ready to exit, we've got a problem. So, yeah, we can have a chat about that.
Thank you. Any other questions? No? Great. Is there anything else you guys wanted to cover? Any final thoughts?
I think the other thing I'd just like to throw into the equation as well is think about the tax aspect of things. I'm not a tax advisor, and my colleagues in tax would kill me if they heard me talking about tax, but I'll do it anyway. I think the key thing is you don't care around what that big number is that a buyer comes along and offers to you and what it says on a piece of paper. You care about what the net cash that's going to go into your bank account, that you can then sit down with Colin and work through. Does that cash give me what I want as a lifestyle? So it's really important to be on top of that in particular. So from a company perspective, there's obviously corporation tax, there's things within the company, R&D credits, some of you will be aware, are coming under a lot of scrutiny lately. Going through a transaction, they're getting scrutinised by buyers who are challenging them and saying, well, we're not prepared to take that on, we think there's a risk there. That's a company aspect and the problems it can cause in diligence. But then you've also got your personal position as well. Tax will often take a couple of years to bed in if you move shares around different shareholders to get the benefit of business asset disposal relief, for example. If that's going to take 2 years before you benefit from that, again, think about it early, start getting that planning in place, don't leave it too late, where a buyer comes along, a great deal, but you've missed out on the window of opportunity to get your tax affairs in order.
You were talking about a matter this morning where you had a client with £10 million worth of reserves set in the company and trying to do an exit in the most tax efficient way. Unless you're doing a specific structure, and EOTs being one of them, which I think is one of the options they're looking at, that 10 million quid sitting in the company is not going anywhere. The buyer's not paying for that cash. You need to extract it. So, going through that thing, I don't want to pay tax, I'm just going to take 50 grand out a year to cover my bills and everything like that. That cash needs to be sorted out. So part of the things that you're going to look at is, at the moment, in the current regime, we don't know what the future is with the new Labour government, so all of this is massively caveated, but that cash needs to come out at some stage. You'll be able to get some of it out, but under the current capital gains tax regime, if your cash reserves and investment assets in that company outweigh the trade, you're unlikely to get your BADR, your 10% relief. So really that's worth 100 grand in your pocket. So it's worth making sure that structuring and timing is done beforehand. Property is another big one. If you've got a big head office in the company and you're merging with another trade which already has a head office, you're probably not going to need 2 buildings in there. They're not going to pay for it. So what are you going to do with the building? You need to start taking that out. Do we look at trying to demerge these assets? More tax structuring, more planning, more paperwork. We mentioned employees and share options and the benefits of doing that. So it's all about thinking ahead, spending that time, speaking to the right advisors, and just finding out what those issues are.
I think just reiterate that importance of pre-planning, that thinking things through in advance. It is the number one thing that people just don't do, but we know that we should. And I know it's hard when you're running the business and that's taking up all the time and the energy, but just taking out a few hours a year just to really think that through. I think the other one on maximising out values is just looking at trends that are coming in the future and how they can really help your business and therefore the valuation. So how can you pitch things that says in the future this is going to really help? Could be anything to do with economics. It could be I was on an AI conference, industry specific, yesterday in London, and I've already been looking at it, but it's blown my mind completely and utterly. Changed the way I'm thinking about our business over the next 3 to 5 years, because the pace of that growth is just mind-bending. We just have not got our heads around it yet. So how can AI really help your business in the future? How can you paint that picture that said if it was embedded, when it's available for your industry, your sector, your specific business, what difference will that make to your bottom line? Because for our industries, I think it's going to be huge. Because anything that can be automated will be automated. Knowledge isn't power at the moment. And that's also thinking it both as an opportunity and as a threat. Is it going to be a threat to your business? So is it better off selling now because you've seen that threat rather than leaving it till later? So I think it's the biggest change that's coming, and it's coming at a pace that none of us that are outside of that specific industry can possibly imagine at this stage.
Gone quiet. One thing you probably heard of, probably worth a mention as well, and just how employee ownership trusts affect the planning. So anyone heard of employee ownership trusts? Anyone thinking about employee ownership trusts? So EOTs, less of a mouthful, came in 20... can't remember what it was. It was introduced, I'm going to say 2014? No, it's before that. Anyway, the whole idea is, if you sell your company to your employees, so the John Lewis partnership kind of thing, but it's not John Lewis, they're not EOT, they happen way before this, they're a very similar model. But if you sell up to 51% of your business to the employees, then you can get 0 capital gains tax on that sale, which is very, very attractive to sellers. The problem is with EOTs is, most of them at the moment, we've seen with some of the early ones, the valuation's quite high, very much vendor-led, not great, but with the market as it is, lending being quite expensive, interest rates are high, people aren't using the EOT model and using lending for it, they're using existing funds. They'll look at the future profits in order to pay out the EOT over the next 5, 8, 10, 15, 20 years. Can't do that anymore. Really need to show employee benefit within 5 to 8 years, I think. These days, you're not going to get your clearance. But the point here being, if you are looking to step out of the business, whether it's going to be 50%, 100% in order to do an EOT, your management team need to be motivated going forwards to return that value, one, to you, but then if they're not motivated enough and haven't got enough skin in the game themselves, how are they going to be happy in order to pay themselves as well as pay you out? Because they may not get an exit, because the OTs are very much about locking in that value. How the capital gains tax relief works is it's a holdover type relief. There's no capital gains tax paid on the vendor, but after 2 years, if you sell, the trust itself will have to pay the tax that wasn't paid in the first place, plus any growth after that. It works out about 60-70% tax. So EOTs and becoming an EOT and then looking at doing further transactions, the management team really do need to be motivated and do need to see the benefits out of doing it, and that's not straightforward. So again, it's all very much about the message, the timing, the structure, making sure that everyone sees the benefit in the long term of this. You know, if by example, if you've got a business with 5 shareholders, all the profits are going to be split at the end of the year between those 5 shareholders. Once the OT's paid out all the debt to the sellers, all that profit is just there. Who's it going to go to? Well, all the employees get $3,600 a year, tax-free. Well, income tax-free. They still have to pay NICs on it, but it's still not bad. But then there's just cash lying around. So once you've got your working capital reserve sorted out, you've still got all these reserves sitting there doing what? Well, I'm pretty sure the management team would like to share some of that, and some of the senior management behind that. So there are benefits still long-term to the income, and there's not going to be a big sale, and you're not probably going to get that £5-10 million we've been talking about to exit, but over a 10-15 year period, you're still looking at a decent-sized income in order to manage that process. So again, EOTs are seen as a very, very tax-attractive thing to exit from, but you've got to think about it, and it's got to be the right fit, because if it fails, it could be very expensive for you. So, yeah, that's the message on EOTs. Anything else to mention?
Nope.
We're on time.
Yeah. Another question, yeah? Come on, run.
That's a question.
Hello there. So just want to take you back to a previous point you was talking about due diligence. So you made a big point about due diligence on the companies, but who and what's the process with due diligence with the investors? And how do we know what working with the right people, the right ethics, the right mindset going forward, the right partnerships? Because that's really important to me.
Yeah. So you're thinking you've got some investors at the table. There's a number of parties that are interested, and you've got to do your reverse due diligence, if you like, to say, well, which one's the right partner?
I want to know what they're about, really.
Yeah. So I think there's nearly 400 private equity investors alone in the UK. So there's lots of different ones. They all look at different transactions in different ways. Some will look at minority, some will look at majority. So the first thing you're going to do is drill that number down to a smaller number, because you might be looking to sell a majority rather than a minority, and that will help build that number from 400 down to a handful of investors. Once you've got the offers on the table, of course, and you've got a handful of parties that are giving you the financial deal that works for you and the overall structure that works for you, it's then about meeting them. It's getting to know them. So the first thing we would do post receiving offers from those potential investors is to set up a meeting, and they would come out and there'd be a presentation, but the presentation is not you presenting to them to get them to buy your business. That is them also presenting back to you. It's telling you what they can bring to the table. More and more we're talking to shareholders that are saying, there's so many people out there who can write a cheque. They've all got the cash. They can all do the deal. But what I want is somebody who can bring added value to that. So that would be what can they offer to help grow the business, because you're going to retain some form of shareholding in the business. So what can they bring to the table to grow that? Is it the expertise in international growth? Is it getting you through the door into retail? Whatever it might be for you, that's what can they offer, and that's the opportunity for them to put that forward to you. You've then got the question around, okay, well do we just work together? Could I sit in a board meeting with these people month in, month out? Could I have them, behind me when I really need them in the tough times? So I think you will get to know them throughout the course. Obviously, as advisors, we have a private equity team, a specialist private equity team, who their day job is just to know what private equity are doing, what they're interested in, what types of people they are, the types of transactions they've done. We will know their track record. We will know what type of investor they are. Are they hands-on? Are they hands-off? So there's different types of approaches there. They will have a track record. They will be able to talk you through. They will also offer you, hopefully, referees that you can go and speak to, other businesses that they've invested into, and those shareholders can tell you their own hands-on experience of working with those investors. So it's really about going through that whole process with them, meetings, getting to know them, and just understanding more about how they will operate with you, where they'll add value, and could you actually work with those people on a day-to-day basis.
Also, it depends, are they already in the sector? Are they entering the sector already? Have they got other businesses that they already own in your sector? Can you go talk to them? Go ask to speak to other investee companies they've got involved in and see what their experience is. Most of them are very specific sector based, aren't they? They're not, some might jump into a new area, something like that. It's a bit risky for them if they don't know it. But look at the portfolio. How have they funded something? When did they exit? Who did they exit to? Did they go to another PE, bigger PE? What's the plan? I think the biggest thing is, are they aligned with the future as much as you are? So what are their hopes and dreams for your business, and does that work for you? Are they going to come and affect the culture? 9 times out of 10, PE are really friendly. They're very soft touch. They're not going to come in and, if they fail, they're not going to just wipe their hands and walk away. They don't, in my experience. They do hang around. They extend the term. They try to do their best. They don't want to be telling the world, we invested in this and it didn't work. Never happens. They are there to work with you going forwards, and 9 times out of 10 it's light touch, but at the same time you've got to be realistic. If you're going into PE, their model is going to be developing your business from where it is now by 300 to 500% in 3 to 5 years. That's hard work. So if you're not scalable right now to do that, and that's going to be a big ask, if you have to end up 6 months in going, actually, my existing business plan is useless, we need to now divert and go over here, and you lose 2 years, that's going to be a problem. So you really need to be ready for that. You need to know what that scalability looks like, how are you going to achieve it, and then get the PE house to come in and say, right, I'm sold on that, I'm good.
I'd also ask, are there specific concerns that you've got, or certain things that you're trying to protect, and how do you go about doing those?
I'm at the beginning of the stage, so the process. So it's there's a lot of questions, a lot of things I just don't understand at the moment about this process. So this is part of the reason I'm here.
So, for me, for example, if I was selling Equilibrium, and I'm not for the clients in the room, then it would be really important to me to protect the staff, to protect the brand, to protect the model. And I could sell out to, let's say a 12 times multiple that would trash all of that. In this industry, the best value comes from the worst buyers. And that's not something that I would consider. So I would rather sell for less money to protect the things that I value the most, than maximising out the paycheck. Now that's different business to business. Our business is very, very personal. If you're a software business and it's just about the tech, who cares? In many ways. So I think going into it and thinking what's really important to you that you want to protect post-sale is a very sensible and reasonable question to be asking.
I think if you do engage with an advisor and speak to them and say, well, we will know who the private equity house is, or the potential investors are. We'll know their track record. We'll have probably worked with them before on transactions. We can give an appraise of, okay, they're nice to work with, they're not so nice to work with. There are different types out there. We can also give a view on, is that thing that they're asking for, and they will have downside risk protections in legal documents as an investor. They'll have rights where if things go really wrong, they can swamp the board, for example. But you might sit there and say, well, is that normal? Is that something I should accept? Is that something that all private equity investors will look to do? So that's about sitting down with an advisor and going through that conversation, going through the credibility of that investor. Is it someone you've worked with before? What would they like to work with? Have they got a good track record? Can I speak to people who've invested in them before? Doing all those things, but then it comes down to, once you've answered all those questions, it's really, do I feel I could work with these people over the next 5 years?
Any other questions? Oh, yeah.
Hi. You mentioned something that in order to sell the business, there was a certain document you had to have, and if you didn't have it, you can't say it. Could it be replaced? Or?
Yeah, they can. But if you've got a 20, 30-year-old company which has been trading for that long and you lost these and we have to reconstitute them from scratch, some of the pieces of paper will never come back. You'll lose stock transfer forms and stuff like that. So it's possible. But what normally happens is it always is left to the last minute. How many deals have we seen whereby, the stat books with the accountants, they go hunt for various firms of accountants and never find them, and then it holds up completion by weeks because you have to go through this process, and it's not cheap. If you get a lawyer to do that at the time, it's not a cheap process. It could cost thousands of pounds to do it, depending on how old your company is. So, and it happens on every deal. So it's just spending that time beforehand. Just on the point of due diligence and going through this bit of prep and everything beforehand, don't worry about what the law says necessarily or what HMRC is going to do. If you want to know what standard due diligence and work you need to do, always have in mind when you come to sell, the lawyers are going to pick through and find every single hole in every single thing that you've done while you've owned that company. That's our jobs. If we are buying, we are looking for the issues because we're risk averse. We have to tell our client, if we miss it, we're in trouble. So we need to flag all these issues with the client to say this is potentially a risk, and therefore you need to now get some either adjust the price or put some protections in place to allow you to adjust the price because it's all about that risk. So never think, have I done enough? It's never going to be enough. It has to be the standard of what we're expecting here because that's it. And that could make the difference of changing the price by millions, or delay the transaction, or it falls over. And trust me, you do not want a deal to fall over at the last minute because it's a very expensive process to start all over again. So really planning ahead, doing that thinking, doing the extra bit of work. Don't cut corners to think, obviously I'm selling, but it's not like a case of, do I really need a lawyer to do that? Can I do it myself? Probably the answer, if you're asking that, is no. Go speak to someone and just get a second opinion and just say, right, okay, how we do it? Because trust me, whatever you spend now on legal fees or professional fees will save you a lot more later down because you're looking at whatever that cost is multiplied by 6, 10. You're talking about its EBITDA. That's the cost of it. So it costs you 2,000 now to fix something. It could cost you 12 to 15,000 as part of the deal to fix it instead once you put the multiplier in. So there you go.
We established a data room about 5 years ago now, and every single legal contract's in it. From the coffee machine supplier to the photocopy leases to this ongoing security maintenance, and it's just having all of those things in one place. I've bought a new house recently, and just going through the conveyancing process was really painful. You have to take out indemnity policies to make sure I don't have to pay for the new church roof. You have to make sure you've got all your gas safety certificates and due diligence on a business is just that on steroids. It's just thinking about every little tiny detail, and it is a painful process.
And I think that on steroids is a great way to describe it. I think you'll often speak to buyers, investors, and they'll say, "Don't worry about it. You know, it'll be light touch. We do light touch." There's no such thing as light touch. They're about to spend a lot of money on your business. They're not going to risk it and do light touch because they can't risk it. So just remember, even light touch is still very intense.
Great, thank you very much. Oh, another question at the front. Thank you.
Nice run there.
Is this about right?
It is. We can hear you, John.
Okay. I have a completely different interest in than you're discussing this morning, and it is that I don't want any money. I want more money, like I want a hole in the head. I want to save money. I want to use money, and I would like to know whether you can give any clues as to the best way of avoiding inheritance tax. That's the big one.
Yes, it's a short answer. So tax planning, usually my team would get involved in the inheritance tax planning, but we'd usually get a tax advisor as well, and we'd work with I don't know if you've already got a tax advisor, but we usually work together, and there's a number of things to consider. Obviously, it's doing your tax efficient wills, but there's a lot of tax planning done outside your wills, and there may be a combination. It's not just one size fits all. It's not just one solution. It might be a combination of things, gifting and other things, and usually using trusts as well. And it depends what your assets are as well. So the first stage would be a good review of what you've got, of your estate, and getting a tax advisor involved. But happy to talk to you about that afterwards.
Just to make the point, for all those people who are trading businesses at the moment, your shares are free of inheritance tax. As soon as you sell and you turn all that lovely shares into cash, you're going to pay 40% on death. So the inheritance tax planning, we discussed it at the last presentation we did, is very, very important, as you say, in order to avoid that charge. And the sooner you start doing that is definitely, we need to speak to someone immediately to try and start planning that, because gifts, are fine, but you need to survive 7 years to avoid any charge to IHT on that. So the sooner you start planning and doing that, the better we can, minimise any risk there.
It really does depend on your circumstances as well, because you might not want to gift directly to individuals, and as I say, it does depend on the assets. So it's important to have a full review first, so we can see it's very tailored to the individual. It's not a one size fits all. Any other questions? No? Okay. Well, thank you again. Thank you very much for joining us. And if we could just have a round of applause for our panel.